Australian dollar remained under pressure this week, on Tuesday falling to about 71.5 cents, its weakest point since the start of March. Since then, however, it's been able to stabilise, mostly trading around the 72 cent level. The Australian dollar weakened somewhat on Tuesday during the appearance by RBA Governor Glenn Stevens for a Q&A session. However, we don't think he really provided any clear indication on where interest rates are likely to go near term, so we suspect that the Aussie dollar weakness was linked to other factors. Governor Stevens' remarks were mostly focused on big picture issues, and in fact market interest rates were little changed on the day, just a little bit lower, continuing to price in one more rate cut this year, which is fully priced by November, and only about a 10 or 15% chance of a rate cut in June. Westpac continues to expect another rate cut, with August the most likely time. The Aussie dollar has already fallen 5 cents since the RBA cut rates in May, and we suspect that enough is priced into the Aussie at these levels in terms of the RBA risks for the next few months. There is a little bit of renewed pressure on the Aussie, however, from commodity prices. Iron ore prices continue to fall and have now fallen below the $50 mark per tonne for the first time since late February. While the Australian dollar has been able to stabilise against the US dollar in recent days, it is certainly struggling to rally. Part of this comes from broad US dollar strength, as the US dollar has risen against almost all major currencies over the past month. This has been largely driven by increased expectations that the Fed will raise interest rates sometime soon. A lot of the debate is over June or July, but a rate hike is fully priced by December. As for June, pricing has risen to about 30%. The question is whether it can go much further from there. Our expectation is that in the week ahead, we will get some fairly soft readings on the US economy in terms of the manufacturing sector, and also perhaps another soft payrolls reading. This may be enough to keep pricing for that June rate hike around about the 30% or lower mark, and therefore not provide fresh support for the US dollar. In the week ahead, there's a lot to watch in Australia's calendar, including April data for a range of indicators, but most eyes will be on Wednesday when we see Australia's Q1 national accounts figures. Recall that it was the Q4 GDP numbers that kicked off the Aussie dollar rally on the 2nd of March from 71.70 all the way up to 78 cents. We have now completed a round trip within that quarter back to that 71.70 area. In Q4, it was an upside surprise of 3% GDP growth year over year that boosted the Aussie dollar. In the first quarter, Westpac expects GDP to have grown 0.6%, which would leave the year-over-year rate at 2.7%. It's not a bad reading, but it's not great. It should be enough to keep the Aussie dollar within familiar ranges because it won't impact RBA pricing too much. So in the week ahead, we expect the Aussie to trade mostly a 71.50 to 73.50 range. We'll speak to you next week.